I spent years overcomplicating trading, jumping from indicator to indicator until I discovered what actually moved the markets: liquidity. Once I understood this concept, I made over $1 million in just 2 years. Today, I'll break down exactly how institutional traders hunt liquidity and why most retail traders get caught on the wrong side of these moves. But first, if you're new to the channel, my name's Kyle and I've been trading the markets for the past 14 years. It took me nearly a decade to become profitable, and that's why on this channel, I'm sharing every valuable lesson that I learned so you don't have to go through the same struggle that I did. But enough of the small talk, let's get right into the video. All right, so first things first, what is liquidity? So it's basically how easily you can buy or sell something without causing a big price change. So think of this like a busy street market versus a quiet one. In a busy market, you can quickly buy and sell since there's a lot of traders, but in a quiet market, one big order can move prices. So we have individual traders, we have retail traders, hedge funds, banks, and different institutions that all create liquidity. So when we're looking at the trading floor, or what used to be the trading floor, these are all individuals, and some of these people represented, different brokers. Some people were in here just trading their own capital. Some people were trading investor funds, things like that. So each one of these people added liquidity to a marketplace, and this might just be one trading pit. This might just be the NASDAQ or lean hogs. So one of these pits, right? There's tons of different participants that will add liquidity to a market. Now, let's say if there was only 2 people in the pit and this market was very thinly traded. Well, essentially, one person could cause that market to jump in price just because there's no other traders that are available in the pit. Let's talk about the different types of liquidity first and foremost. So as an example, we have this infographic just so I can get you guys to visualize how I think about liquidity and how you should also think about liquidity. So when we look at a chart, right, we have old highs and old lows, and we have current market price. And now let's assume for a second that Gordon Gekko is a buyer and Jordan Belfort is a seller. So in all these examples we're going to go through, we're going to have different orders and maybe different interest from both of these parties. And for the purposes of this video, we're only going to be including 2 examples, just so you guys don't get confused. So if we execute an order at the current market price, right, that order is going to get filled at 20,915, as you guys can see on the right here. It's either going to get filled at 20,915 or the next best price. So let's just assume that Gordon Gekko comes into the pit and he says, I want to buy this market at 20,915, but the next closest seller is at 21,000 even, right? That person's going to get slipped on that order because Gordon Gekko wants to execute at the market. So whatever the closest offer is, his order is going to get filled. So there might be some slippage, and that's the downside of a market order. Okay, so this is not adding to liquidity, but as soon as he places that order, it adds liquidity into the marketplace. All right, now let's assume for a second that anything above the market is in the form of a buy, stop, or sell limit. So we have a market order, and then any resting order that's above current market price is going to be a buy, stop, or sell limit. You cannot put a sell stop above the market, and you can't put a buy limit above the market. That's just not how the markets operate. If you try and do that on your broker, it's going to give you an error. Okay, so any order that is resting above the market is going to be a buy, stop, or a sell limit. So as price, right, trades higher, it's going to continue triggering new buy stops or new sell limits, or it's going to trigger people that want to execute at the market. All right, and then vice versa, below the market, we have sell stops or buy limits. Okay, you cannot have a buy stop or a sell limit below the market. All right, so those are just the types of orders. Now, you guys might need to pause this video and double check this and rewind it as I go through the examples, but this is the pending liquidity in the marketplace. All right, so as the market trades lower, it's going to trigger sell stops or buy limits. All right, and we will get into, how these participants in the market as liquidity interact as the market goes up or down. So knowing this type of liquidity in the market, right, allows us to visualize where there might be interest and how we can analyze a chart. So let's go through some examples and just keep this in mind as we're going through them. So here we have a range. As you guys can see, we have this high here and this low. So this is creating our trading range. All right. And as long as this high is protected and as long as this low is protected, there's sell stops below or buy limits below the market, or there's buy stops or sell limits above the market. Okay. Now let's fast forward in price and just observe what happens. All right. Now that the sell stops have been triggered, let's just assume that Gordon Gekko, as a smart money player that he is, he wants to buy these sell stops. All right. So what happens is he's going to have his buy order paired with a sell order. All right. Because in order for you to be a buyer, there needs to be a seller. You cannot buy if there's no seller. All right. So maybe his buy limit was there. So his buy limit gets triggered as soon as the market goes there, because it can't get triggered if the market's trading up here. All right. Let's just say he had a pending order and he wanted to buy it at a discount. It goes down there. His buy limit now all of a sudden gets triggered and paired with a sell stop. All right. Because somebody else is willing to sell it there. Now, keep this in mind. There are two parties. Okay. People can use a sell stop. Let's say if they're sidelined, they can use a sell stop to get them into the market as a short seller when the market gets triggered there. Or let's assume if they were already long, then their sell stop would be a protective sell stop. Okay, so when that price gets triggered, then they'll take a loss. Okay, so there's two different parties that we need to think about. There's people that are on the sidelines that maybe have sell stops, or there's people that are already in the market that are getting stopped out at a loss. It doesn't really matter. Gordon Gekko, his buy limit is going to get paired with a sell stop. Okay, because you can't pair a buy limit with a buy limit, all right? So now let's just assume that he bought this market and he's looking to exit the trade. So now that he's long, okay, so he is now in the market, right? He bought it as he's a buyer now, so he bought it here, and his sell stop is here. Okay, because when you buy something, the only way that you can get out of that trade is a sell. Okay, so he's got a sell stop here, and then his sell limit is up here. His sell limit is his profit target. So when you place a TP, right, a TP, when you place that TP, it will be in the form of a sell limit. All right, so let's roll price forward and then see what happens. So now that this price has expanded higher, his sell limit that was already placed in the market, gets paired with a buy stop. Okay, so now that his sell limit has been triggered with a buy stop, he's able to exit the trade because he was able to sell it to a willing buyer. All right, now again, I'm going to run through this scenario. The willing buyer could be two different parties. It could be somebody that's sidelined, willing to buy this market on a breakout. So his buy stop will trigger and he'll enter a long position. Or it's somebody who was short in here, right? So when they go short, how do they get out of the position? They have to buy it back. Okay, so when you enter a short position, your buy limit will be your take profit and your buy stop will be your stop loss. All right, and we'll run through another example in just a second. So Gordon Gekko is now out of his trade. He profited whatever he profited on the trade. Maybe it was a couple $100, maybe it was a couple $1,000. Now Jordan Belfort is interested in selling this market. Okay, so he's also a smart money participant, right? Maybe he already had a sell limit that he wanted to get short the market as soon as it ran out this high. So if he had a pending sell limit, it would have triggered him in there. And so this sell limit, he would have had to place it while the market was trading down here. Because why? You cannot place a sell stop above the market, right? That's only if the market is going down. So anything, let's say current price is here, any order that you place above the market to sell is going to be a sell limit. Any order that you place that's going to be a sell is going to be a sell limit. Okay? So his sell limit is now what? Going to get paired with a willing buyer. All right, because in order for you to sell it, you need to borrow it. And now that you're short, what is this here? Your stop loss is now a new buy stop, all right? Because you're already in the market. You're already in the market, and in order for you to exit the trade, you need to buy it back. So your buy stop is going to go here. So that is your stop loss, right? This is why it's a stop loss, right? So when you're short, it's a buy stop. This might be going over your guys' heads, but again, pause the video, take some time to really comprehend this. That way you can understand the examples that I'm going to go through. So now that he's short in the market, let's roll price forward again. So not only was he short here, but what they ended up doing was they ended up running out another short-term high. So Jordan Belfort is not the only participant in this market, okay? And depending on where his buy stop was, he may have gotten stopped out of the trade, but because it was up here, he didn't. Now, as it's running this high out, maybe there's more people adding to liquidity inside of this level. So as it's running out this high, they're triggering more and more sell limits or buy stops, right? But if the market is predominantly ready to go lower, the smart money or short sellers are going to have their sell limits paired with what? Retail buy stops. So anybody that has a buy stop here is either getting stopped out at a loss, right? Because they were short here. They might have been short here. They're getting stopped out at a loss, or they're buying it on a breakout. So if they bought it, buy stop on a breakout, now all of a sudden they're on the losing end of that trade. Okay, so this example really is just to give you guys, an understanding of how participants are moving in the market and why liquidity is so important, because it's giving you a narrative. All right, so once Jordan Belfort's short position runs down here, his buy limit is then what? Right, because you have to buy it back. His buy limit is then paired with a sell stop, right? A willing seller. You have to be able to buy it back. So you have to be able to buy back your position to cover your short position. All right. So why use liquidity? First of all, understanding liquidity is so important because it just provides actual context behind why the markets move the way they do and respect certain levels. So those two previous examples that I had shown, you have to understand why those levels, right? If I go back for a second, you have to understand why these levels are being rated the way they are. And, why is it reacting where they are? Okay, so smart money is going to position themselves, right? Their long positions below this level because they know that there's willing sellers there. All right, so they're buying it up in a discount and then selling it at a premium. It provides context. It gives you narrative. That way you're not just lost in the markets, not knowing why price is moving the way it is. Traditional indicators are lagging, and this is where I got caught up for a very long time, was I thought that the indicators were going to give me a better narrative of price action, but really it kind of just got in the way. When you're looking at raw price, that price feed that you're getting is accurate. It's up to date. They can't fake it. Maybe on FX brokers they can, but with a market like futures where it's highly regulated, that price feed that you're seeing is going to be the same on every single platform, and it's not lagging. So when you see an old low being penetrated and there's lack of a displacement below it, and you see it close back in the range, well, we have to start assuming that maybe people are accumulating long positions below that low. And vice versa for short positions. If we're taking out short-term highs and then we're failing to run higher and we close back below that old high that I just took out, well, it's failing to run higher. And we have to start putting ourselves in the position of, well, maybe people are actually shorting into those highs. So while traditional indicators are lagging, price action does not lag. And you can see with your own eyes at those major levels if liquidity is being swept up, because they will react pretty quickly. You don't want to see an old high or old low be penetrated and kind of just meander around. That's usually an indication that it's going to continue higher or lower. Usually, if there's a very strong pool of liquidity, it's going to take that level out and reject pretty strongly. All right, so not only that, but studying price action in this lens provides an additional psychological edge. So when we're looking at the charts, we have to think that there are other people on the other sides of these trades, and that there are emotions being displayed on the charts. And this is something that we lost when the floor went away. You couldn't see people's reactions at specific levels, right? We have to do a good job of anticipating and trying our best to put ourselves in the shoes of somebody that might be trading against retail. Okay, so when we are trying to build a psychological edge, you have to understand that there are certain emotions in the charts. And what I try and do is try and understand, who's trapped in a trade, where are people trying to target to exit their trades, right? So when we see very clean levels like double tops and triple tops or bottoms, those levels oftentimes provide a really great exit point. Okay, so you can pair your exit, whether that's it's usually a limit order. So you can either pair your sell limit or buy limit with a specific level, and that it has a high likelihood of it reaching that level because there's more stops resting below those specific levels. How do I trade with liquidity, and how can you trade with liquidity? So I'm going to go over just a couple different things, and these are all things that you need to practice on a regular basis and get used to. So when we're identifying liquidity, right, where are most stops and limits going to be resting? Old highs and old lows. So we have previous month, week, day. Every single candle that gets printed is going to have some level of liquidity at the highs and the lows. And this is why intraday is a little bit trickier, because on an intraday level, there's not as much liquidity above a 5-minute or 15-minute or 1-hour high compared to like a daily or a 4-hour high, right? It just doesn't have enough time to build that liquidity in. So not only do we have old highs and old lows, but we have the Asian range. Okay, now the Asian range I use a lot in my trading because we have to think about it. Right? We have all these traders during the Asian session that might be placing their positions, and as that liquidity gets built up during the actual trading session, it might run one side of that liquidity and then go the other way. Same thing with the London session range. We might run one side of that liquidity and then go the other way. So these are all important liquidity ranges that we need to pay attention to. Okay, so this is all time-based liquidity. Then we have the lunch hour. So the lunch hour, very similar. We might have that 12 p.m. to 1 p.m. candle. We might raid one side of that and then go the other direction. All right, key times when liquidity gets taken. So we have high-impact news events, and we have individual trading sessions. Sometimes with high impact news events, liquidity might be taken beforehand, and then we'll get an expansion in the direction that it's trying to go to. And then other times when liquidity hasn't been taken, then it's more of a crapshoot. We don't really know which direction it's going to go. Usually the trades that I take where I'm positioned pre high impact news is typically when we've already seen a major level of liquidity taken out, and it's not an event that I really should be worried about. Okay. Then we have individual trading sessions. So during each session, we might see a raid on liquidity. All right, so entry and exit. Refer back to the examples that I went over. Identify where you can position yourself in line with high time frame bias. So if short, position yourself above old highs or wait for rejection of old highs, right? And if you're long biased, position yourself below old lows or wait for a rejection of old lows. And then we're just targeting the opposing range liquidity. So this is exactly how I trade with liquidity. Now let's dive into a live trade example. Okay, let's talk about this trade that I'm looking at right now. So we have equal lows down here, right? And that's really kind of my target. I'm pretty sure this market traded much lower. And I'm not going to bring up the actual symbol name or the market that I'm trading because it's irrelevant. All markets move like this. So what I was looking for was this equal low level to be ran out. And all I needed was to get on side with that idea. And what we're looking at is Monday, right? And Friday. So we have this time-based liquidity, a previous daily high, right? That's our buy side liquidity. After we've taken out that buy side liquidity, right? We get a strong rejection. So we get very strong displacement away from that old high. Okay, so after we get this displacement from here, and just think about the example that I went through, right? If there was smart money liquidity, right, they're using buy stops to sell into. So they're selling into these buy stops that are getting triggered. And it's causing this cascade of price lower, right? We get this nice displacement lower. Failed to just displace above this old high, and we get a nice run lower. All right, this is my indication that they're possibly going to target the equal lows that are back here in the form of sell side liquidity as their target. Okay? So what they're going to end up doing is they recognize that there are sell stops down here, and what they're doing is possibly setting their target, a buy limit, right? Their buy limit when they entered here, their buy limit is their take profit. And that's the way that I need to think. I need to think like somebody that's smart money. Right, so what I ended up doing was I'm just trying to catch a little bit of the move running down into this level. So I ended up shorting it here. This is a 1 hour breaker, and then we have a fair value gap. But really the whole idea of this trade is the failure at this buy side liquidity. Okay, so the whole premise of this trade, regardless of whatever you see in here, right, because you could blindly short this level without any confirmation. And having a level down here, right, just visualizing that liquidity and understanding that the market will trade to that level is extremely important. Okay, so you guys can see that it's really drawing price lower. All right, we had another fair value gap that popped up. And as we approached the daily low, I just exited. Okay, because this was the last day of the year. You guys can see that this is the 31st. I don't need the full amount. I believe I only got like a 1 hour out of this. But the idea is that the context is there, all right? This market did eventually trade to those old lows, but because it was the last day of the year, it was 9 a.m., I pretty much exited on that hourly close. And to be honest, that was enough for me, all right? You guys can see here that it was roughly what, 3K, 6K, about $8,000. Okay, just using liquidity as context. So if you want to learn how you could trade these setups live with me, then book a call using the link in the description. If you're a struggling trader, I guarantee I'll get you funded with 6 figures in capital in under 6 months. And if not, I'll sit with you every single day until you do. Also, don't forget to like, comment, and subscribe, and I'll see you guys in the next video.